Hi there. Today is part 2 of our series on international currency markets. I shall be discussing international commercial transactions and their accompanying foreign exchange risks and what to do about them. Just to recap, in part 1 I focused on implications for nations. As a postscript, I should share that British PM Liz Truss resigned last Thursday, making her at 6 weeks the shortest-lived British PM in history. Her economic policy actions resulted in a catastrophic loss of confidence in her leadership, and seemingly there was no way back from that. The irony, of course, is that the man she replaced, Boris Johnson, is now one of the leading candidates to replace her. As I previously indicated, Part 3 will deal with currency unions, and Part 4 with reserve currencies and dollar dominance. I have decided to add a Part 5, which will focus on international remittances. And now on to today's discussion. But before I continue, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. When I first heard the term derivative in one of my finance classes, I thought, piece of cake. After all, I had a degree in math. Unfortunately for me, it turned out that this was a different kind of derivative. Of course, it didn't help that I had joined the class 5 weeks after commencement and had missed the foundational lessons. Although the concept of derivatives was much simpler, the techniques and calculations were just as hard. But more on this later. Firms engage in international transactions for several reasons. I shall highlight here only the main ones. First, firms invest or open branches overseas as part of foreign direct investment. Second, firms sell or buy machinery and/or intellectual property internationally. Third, firms sell or buy goods and services internationally. Fourth, executives and employees travel overseas for business reasons. All these transactions involve the use of international currencies, and certainly the first 3 currency risk, at least for one of the counterparties. These firms, therefore, face exposure to currency risk through adverse movements in exchange rates. It is the CFO's job to assess this risk and understand whether the effect is material and needing to be hedged, or is small and can be ignored. These risks can be divided into 3 distinct but interrelated categories. 1. Transaction risk arising from gains or losses due to exchange rate movements. This exposure affects all business cash flows denominated in currencies other than the domestic currency, including trade receipts and payments, dividends, interest payments, loan repayments, investments, and so on. 2. Translation exposure relates to the change in accounting income and balance sheet statements caused by changes in exchange rates. 3. Economic exposure is the risk that the value of the business, expressed as the net present value of its future cash flows, will be affected by exchange rate movements. This exposure is all-pervading and may affect even a firm with no direct overseas exposure. Currency risk management involves 3 processes. First, the quantification and analysis of the risk in terms of the present situation and various time horizons. Second, the development and implementation of strategies to deal with exposures, including minimization or elimination of the risks through, for instance, the following. 1. Reducing risk exposure to currency movements through sourcing materials in local currency and matching cost and revenue. 2. Reducing or avoiding the amount of trade credit. Where exporters are strong and can shift the problem of exchange rates onto the importer, risks can be removed. 3. Obtaining trade credit or borrowing in the local currency. 4. Netting where participating subsidiaries of the same group are netted so that each subsidiary pays or receives only the net amount of its intra-company purchases or sales. Third, if risk cannot be avoided, the use of various hedging techniques to eliminate or reduce positions. With respect to transaction risk, the strategy of the firm may range from a position of covering all exposures to covering no exposures. In contrast to transaction risk, translation exposure does not involve any direct cash flow or profit and loss account impact. Nevertheless, changing foreign exchange rates with their consequent impact upon the net worth of overseas subsidiaries may have adverse effects upon target corporate gearing ratios, performance ratios, and loan covenants. For these reasons, consideration must be given to translation risk management. Risk reduction does not come free. Transactions undertaken solely to reduce risk do not add value. Why not? There are two basic reasons. 1. Hedging is a zero-sum game. A corporation that insures or hedges a risk does not eliminate it. It simply passes the risk to someone else. 2. Investors do-it-yourself alternative. Corporations cannot increase the value of their shares by undertaking transactions that investors can easily do on their own. However, risk-reducing transactions can make sense in practice. Transactions that reduce risk make financial planning simpler and reduce the odds of an embarrassing cash shortfall. This shortfall might mean only an unexpected trip to the bank, but a CFO's worst nightmare is landing in a financial jam and having to pass up a valuable investment opportunity for lack of funds. In extreme cases, an unhedged setback could trigger financial distress or even bankruptcy. Hedging involves taking on one risk to offset another. The tools used for this are called derivatives or derivative instruments because their value depends on the value of another underlying asset. Derivatives consist of options, forwards, futures, and swaps. For firms with international exposure of one form or another, sharp exchange rate movements can make a large dent in corporate profits. The techniques for hedging currency risk are many and varied. Just to highlight some of them and some underlying theoretical considerations. 1. Forward contracts, which represent agreements to buy or sell specified amounts of a currency on an agreed future date at an exchange rate fixed when the contract is entered into. As well as fixed forward contracts, there are forward option contracts where, instead of delivery on an agreed date, delivery may take place between a range of specified dates and piecemeal if so desired. 2. Options, which must be distinguished from forward option contracts, which are a right but not an obligation to buy or sell currency at an agreed exchange rate for a specified time period. 3. Futures offer the opportunity to buy or sell foreign currency in agreed units against dollars on a specified future date with the exchange rate fixed at the start of the contract. Quotations are in currency per dollar and cover is typically available in Deutschmarks, sterling, Swiss francs, and yen. 4. Currency exchange agreements which relate to parallel loans and swaps. 5. Discounting. Bills of exchange denominated in a foreign currency may be discounted and converted at the current rate, the exchange risk being eliminated for the cost of the discount. 6. Factoring. And 7. Export credit guarantee, which offers insurance against exchange risk. Some fundamental theories exist linking exchange rate variations with economic causation. These include the four-way equivalence model, which states that given open markets, there is an equilibrium exchange rate for a currency determined by interest rate, inflation, and spot to forward differentials. The four relationships in equilibrium are given by 1. The interest parity theorem, which holds that the difference between spot and forward rates equals the difference in interest rates between the currencies. 2. The Fisher relation, which states that interest rate differentials reflect and are equal to differences in inflation rates. 3. The purchasing power parity theorem, which puts forward that currencies are valued according to purchasing power, and therefore movements in spot rates will equal inflation differentials. If you have heard of the Big Mac index, it is based on the Triple P theorem. 4. The forward parity theory, which contends that forward exchange rates are equivalent to future spot exchange rates. Overall, the four-way equivalence model argues that if real interest rates and purchasing power between the domestic and foreign economy are equal, then forward exchange rates will match future spot rates.